Hello and welcome to the September 16th, 2022 edition of Watching the Tape. One of my guilty pleasures is tracking a handful of growth stocks with stratospheric valuations. After all, one of my favorite reads is this, Extraordinary Popular Delusions and the Madness of Crowds, which is all about crazes, manias, absurdities, bubbles, and fads throughout history. And if you think that we've somehow collectively evolved past the follies of the people highlighted in this book, then I don't think you're looking hard enough. As I scan the chapters in this book, I see alchemy, witch hunts, fortune telling, haunted houses, and yeah, I think that in the circles that you and I run in, we're probably not seeing a lot of that anymore. But I still think that we human beings are susceptible to folly. So getting back to my short list of growth stocks, I'll highlight one that has defied reason in my eyes from the get-go, right from its IPO in May of 2019, but it's taken a little bit longer to unfold than I would have expected. And the company is Beyond Meat. It makes plant-based imitations of foods like burgers, jerky, sausages, chicken, etc. And I'm not necessarily pro or anti-meat or vegetarianism. My favorite sandwich at Jimmy John's is the number 6. It's the veggie. I get it just about once a week. But my only experience with fake burgers was the Impossible Whopper, which I rushed out to buy within days of it being offered by Burger King a few summers ago. But that was the one and only fake burger I've ever had. There was really no need to go back for more. But boy, oh boy, was there some euphoria surrounding the IPO of Beyond Meat. It IPO'd, like I said, in May of 2019 at $25 a share. And I'm going to highlight that right here. And then it shot up within about 3 months to $234 a share. And within a month of the IPO, a big, well-known investment bank published a research note recommending that investors buy Beyond Meat stock. It was trading at $80 at the time, so it looked like it was a good buy at the time. But as you can see, Beyond Meat has had a rough road since then, and now the share price is all the way down to about $20. So that same investment bank put out a sell rec on the company at some point along this stretch. But this video is not about the impossibility of timing markets. That's a separate matter. What I wanted to take a look at was how investors were valuing the stock of a young company that hadn't produced any positive profit yet. And so what I did is I compared the estimated future earnings from that May 2019 research note with the actual earnings over the ensuing 3 years. So, I mean, after all, there has to be a basis for valuing a stock or an asset. An asset is the present value of the future cash flows that it generates. So for stocks, a popular valuation metric is price to earnings ratio. Another is enterprise value to EBITDA. There has to be earnings or there has to be EBITDA in order for those metrics to make any sense. And it has to be at some point in the future, you have to have cash flow, earnings, EBITDA, whatever it is, in order to have a valuation that is somewhat grounded in reality. So let's go to the numbers. So this table was pulled from the May 2019 research note. And so what it includes is the actuals. Let me grab a highlighter here. So the 2018 actuals right here, and then the estimated financial results over the next 3 years, 2019 through 21. So let's highlight a few numbers here. So 2018 actuals. Beyond Meat generated $88 million in revenue. And by 2021, it was expected to generate $504 million in revenue. Okay. And EBITDA in 2018 was negative, but that was expected to turn positive by 2021. And cash flow was also negative in 2018 and was expected to kind of turn the corner, kind of be flat by the year 2021. All right, the last thing on this page worth noting is that the price to earnings ratio based upon 2021 earnings. Now, keep in mind, this is in 2019 when this was written, was expected, well, was 225 times earnings. It's absolutely bonkers. And it's not only high, but it's far into the future. All right. So that was then, this is now. So this table was pulled from the August 2022 report research note from the same investment bank. So we have the 2021 actuals here. And so what I thought would be helpful to do is to compare the 2021 estimated financials with the actual 2021 results. So we're looking back to what was estimated, and that provided the foundation or the basis for what stockholders were willing to pay for Beyond Meat back in 2019 and drive it all the way up to $234 a share. But what did 21 actually look like? And so in order to make the comparison a little bit easier, I put together a side-by-side, and that's what this table is right here. So 2021 estimates, 2021 actuals 3 years later. All right, revenue was expected to be 504 million. It was instead 465 million. That's actually not a big miss. Let's go down the list here. EBITDA was expected to be positive. It is massively negative, or it was massively negative at negative 113 million in 2021. Cash flow was expected to be turning a corner and becoming positive, or at least heading that direction. Instead, free cash flow in 2021 was negative $437 million. That's considered a cash burn. $437 million of cash burn on revenue of $465 million. This is just awful. Gross margin was expected to be 36%. Instead, it was 25%. And if we look at the valuation ratios or metrics at the bottom here, you can't even calculate them because we're nowhere near positive cash flow earnings or EBITDA for this company. So let's wrap this up with a key takeaway. It's a prime example of why we are so leery of growth stocks and instead have a value bias. Too much of today's valuation of growth stocks is dependent on earnings that are to occur or expected to occur in the distant future. And well, those earnings may never occur. And so I realize that the twisted sense of enjoyment that I get out of watching a growth stock crater towards zero is probably a character flaw. And I usually make great efforts to hide my character flaws, but this one was just too irresistible. There has to be a legitimate basis for asset valuation. It can't all be euphoria based. That's it for this week. We'll see you in 2 weeks.